Exactly. All right, everyone. My name is Jessica Morrison, Realtor with Ferris Property Group. I have with us tonight Kim DeWitt with
You got it.
Highlands Residential Mortgage, and they are an awesome lender. And if you know anything about Kim, all you have to do if you're not familiar is to just go in the Facebook chatter pages and ask for a recommendation for a mortgage lender or refinancing, and you will see Kim's name come up. It's kind of impressive how many people tag her. So Kim, thank you so much for taking time out of your evening. Please tell us a little bit about yourself and Highlands real quick.
You got it. Yes. Well, first of all, thanks so much for having me. Totally appreciate you as a realtor having interest in the mortgage side of the whole process, and obviously really honing in on what's going to help your buyers or sellers in the long run with this information. So my husband and I are a team with Highlands Residential Mortgage. We are a national company based out of Dallas, Texas. We have offices in over 17 states in the U.S. And our office is over near Keystone at the Crossing, right across from Seasons 52. Although I have to be honest, I've only been into the office once or twice since COVID, but I guess that's the beauty of working from home. My husband, Mike, has been a loan officer since 1993 when he graduated from college. And I joined him about 5 years ago when I had been in pharmaceutical sales, and it was just time for something different. And the kind of geeky, analytical number brain in me said it might be a good time to try this. So Highlands, like I said, it's a privately owned company. We are, what I love about Highlands is that we are nimble enough that we really have our hands on every single stage of the mortgage process. So our entire operations team, from our processors to our underwriters, our closers, we're all local. I can see them, I can call them, I can jabber them at any given time and can get an answer. So we all work very congruently to best help our borrowers, whether they're refinancing or purchasing. Another thing that I really like about Highlands, we are very, proactive in the mortgage process, meaning that our number one goal is to take care of our clients and hit on-time closings. Absolutely. We fund every single loan one day prior to closing so that our clients aren't sitting at the closing table waiting for hours. Like I said, honestly, at the end of the day, Mike and I really, the biggest thing to me is just treating people the way I would want to be treated. So on top of low rates and all that kind of good stuff. So anyway, hopefully that gives you a little bit of background.
Yeah. So just to confirm, you guys are a local company, correct?
Correct. Yep. We have, like I said, we have a branch that is over at Keystone at the Crossing. We have multiple LOs in the central Indiana area. But like I said, we are a national company. So, we do have the backing there, although we are privately held, which I love.
And for those not familiar with lending, beyond, hey, I just want to get pre-approved. When you say privately owned or have private lending in that capacity, can you maybe just really brief talk about what that means?
Sure. Right. So like I said, we with Highlands, you're not going to get a call center that's kind of the biggest thing. You're not, if you call, I guess I would say, I won't name any names, but like an online lender that you get pop-ups from all the time, you may call in one day and get Joe and then may not be able to reach him again. You may have a slew of people touching your file during the process. That's not, so exactly who we are, who your underwriter is, who your processor is throughout the entire process. We are a lender per se, so we do keep a fair number of our loans in-house and we service those. We have some unique programs as well, a great recasting program, and we absolutely keep that in-house as well. So it's not like we would sell that off to, a secondary market lender. So it's really, we don't work 9 to 5. We're not a bank. So, Mike and I are available anytime. If there's questions or one-offs, I guarantee we'll get back to you right away. So that's kind of the biggest difference, I would say.
Yeah, I like to joke with people that if I'm ever in an accident, I'm not calling 911, I'm calling my lenders.
Seriously, it's so true. In fact, I need to turn off my volume on my phone because I keep hearing it ding. And I'm like, stop. So,
No,
yeah.
it's true, guys. A good lender will get back with you. I know a lot of times we like to try to have a work-life balance if such a thing exists. I think a lot of times it just comes down to boundaries, but good people will get back with you and will be prompt in communication. We obviously try to be reasonable in our response times. I don't think anybody enjoys working at 9 o'clock at night, but you do what you got to do to serve people and get stuff done. I know I could tell you a story, Kim, and I'm sure you could tell me crazy stories as well about how long or how late you've worked before, but all for helping people get a house, right?
Right. And that's the thing. You're cognizant that this is truly, like the biggest purchase most people will ever make.
Mm-hmm.
So I don't care what the price point is, whether it's a $75,000 home or a $1 million+ home, every single person definitely deserves the respect and attention, to help them and guide them. And, I get it. Like you said, they might be laying in bed and there's something that just comes in their mind, and it's like you said, you just try and be as punctual as possible.
Yeah. I think you and I both are on the same page, and we're saying it loud for the people in the back.
Exactly. For sure. Yes.
So, you've been in, just real quick, you've been in lending for how long again?
About 5 years.
Okay. And then
Yep.
Mike's
been in it. Oh my gosh. He's going on 28 years almost. A long time.
So as long as I've been alive.
Oh God, you're making me feel so old. No.
No,
Yes.
just tell Mike that.
I know, right? Yes. He was doing this back when literally if you could fog a mirror with your breath, you could get a loan. Yes. That was, back in the day when, you basically just told what your income was and there was no fact checking. So boy, things have changed. Especially since if you haven't bought a home since 2008, things have definitely changed as far as the mortgage world.
Yeah, and for more on an illustration of that, go watch The Big Short. I watched that a few weeks ago with my husband, and I was just like, you've got to be kidding me.
Right. What? I know. That seriously happened?
Yeah. And that's honestly, I think, and this is a great segue into COVID and lending restrictions, because I think a lot of people have witnessed 2008, witnessed what their parents or someone close to them went through in 2008, or even just, the stigma of what they read in the news. And they're like, I don't want to be in that position. I don't want to be, the sucker who buys at the top of the market and then gets the rug pulled out from them. So maybe can you, I feel like we could have an hour-long discussion on each of these different topics.
Right, I
know. How have things changed since 2008 with the lending?
Right. So, obviously the governing bodies over the mortgage industry, whether that be TILA, RESPA, the CFPB, they're really looking and doing everything they can to protect the borrowers. And so, there's a lot more fact checking. There's a lot more documentation that we need to collect from borrowers. Really just, making sure that they truly are getting into an investment that there's a highly unlikelihood that they would default or have trouble fulfilling the longevity of the loan. So, right, and people, I sometimes totally kid at the end of the process that, at the closing table, don't be surprised if I ask for a blood sample or a DNA sample, because people feel like, we're just asking for everything. But I can promise you, any lender that's asking you questions, they're not doing it just because they want the info for kicks and giggles. It truly is, whether we need bank statements, a lot of that comes in. I think that one of the biggest thing that has been coming up recently is, especially first-time home buyers, they're like, say, for example, I have someone who works in the food business, the restaurant business. And a lot of their down payment is going to come from tips.
Mm.
Well, if those tips have not, the cash money hasn't been seasoned in your account for at least 2 months, we can't use it.
Mm.
So really, we're trying to, you try and coach people ahead of time to prepare and be really set when the time comes to make an offer on the house and proceed with the mortgage process.
Yeah, I think that's a really great point because I've heard that across multiple buyers with different lenders. I'm the common denominator in all of that, but each lender it's a different entity because sometimes they work with someone that I recommend or is on the list or
Right.
Is someone that they've been referred to or want to work with again. And so
Correct.
all of these different companies doing the exact same thing, but the buyer feels like if you haven't set that expectation ahead of time, like this is how it's going to feel, then they're going to
Right.
feel like, oh, they must think I'm a really bad person or
Right.
like,
No,
for
that's a
requiring.
very valid point. Yes.
Yeah.
No, that is so true. And the other thing I think I'm hearing a lot recently, and I think it's just due to the influx of, especially, oh, there's Rudy in the background, the influx of the refi business.
Mhm.
I had somebody text me today and say, what's wrong? Why don't we have underwriting approval yet? And then literally we just submitted the file last week and it's a refinance. And refinances now, I have heard some people even saying that banks are not even they're not promising anything quicker than 90 days, where, we're able to turn a refinance around in 35 to 45 days. And I reassured this borrower, oh my gosh, you're absolutely on track. It's nothing with you. It's kind of in the pipe right now, and
Well,
we'll
and
get
I
back to you.
think, yeah, and I mean, on one hand, yes, it does come down to setting expectations, but I think um, within that, in the communication, if you were to say, prior to COVID, how many refinances did you do?
Prior to COVID, oh my, maybe one a month,
And how many now are you doing?
probably 3 to 4 a day.
Oh my gosh. So as consumers, you
It's
guys can,
absolutely insane. It's insane. We've never seen anything like this. I can't even.
yeah.
It's
And then
just.
I think there was a report, I was listening to NAR's podcast, and it was really helpful because they were talking about things that you need to ask lenders. I didn't get far enough in because of timing, but one of the things that they talked about in that was questions that you should be asking to pre-qualify lenders as a listing agent, which was
Okay.
incredibly helpful.
Yeah.
But the gentleman made a comment that the FHFA organization has added, I think he said it was 0.5% or 0.5 point of fees. Am I saying that
I can
correctly?
definitely tell you about that.
And because I think they're just trying to help slow down the volume of people coming in to refinance. Is that true?
Oh, don't get me started. Yeah. So literally, this is what happened. I think it was August 13th. I remember it well. We get this communication from our ops team that came from Fannie and Freddie, basically stating that they are going to implement a mandatory zero point 0.5 BPS refinance fee to all refinances moving forward. So what that means to your borrower is most likely about 0.25% higher in interest rate than what they would be able to get normally. So whatever the going interest rate is that day, it's most likely on a refinance going to be about 0.25% higher.
Which
So
still, like if it's 2.5% and it's still 2.75, assuming that I'm hearing this
it's
correctly.
right. It's not outlandish, correct? But here's right. But so you've got a lot of those people. I'm assuming like that you'll see with buyers where they're kind of on the fence, like they just can't pull the trigger type thing. Like they just are. I hate to say it, but sometimes just overthinking.
Yeah.
And so yes, you've given them numbers, and then all of a sudden, when they're like, "Okay, we're ready to lock," and you say, "Okay," and then you come back and it's 3% versus 2.75. I mean, depending on the loan size, that can make a significant, like today, I think originally it was about $75 a month more.
Wow.
So yeah, so then what happened was we were all up in arms. We're all calling and talking to the legislators. This is ridiculous that they all of a sudden, out of the blue, implemented this mandatory refinance fee. And so about 3 weeks after August 13th, they lifted it
Okay.
and said, okay, we're going to lift it temporarily. However, we are going to mandate it and re-implement it December 1st. So we
Okay.
all know that become December 1st of this year, that's truly going into effect. Now it's up to each lender, knowing that they're going to have this fee when these refinances are sold on the secondary market.
Mm-hmm.
Some of them are already implementing a refinance fee. So that's why we're seeing people come to us and saying, oh my God, your rates are so much lower.
Yep.
Because, right. So depending on the lender that you go to now, they may have already implemented it to offset the fees that they're going to be having to incur. But, you know, it just, like I said, we know it's happening December 1st for sure.
So basically, your company is going to be flooded until
It's just,
more so.
yeah. And you know what's crazy is I was listening to a podcast yesterday too, and you know, it's funny, you know, when interest rates are low, people start talking, their neighbors start talking and such, but it's almost like the flurry even increases when interest rates start to tick a little bit higher.
Mm-hmm.
And in fact, I was telling a couple borrowers today that yesterday was the first time in well over a month and a half we get what's called an alert to lock. It's basically a notification saying, okay, interest rates look extremely volatile today. Stock market was rallying. You know, anytime we get closer to the election, all of that tends to negatively impact interest rates. And so, sorry, we did get an alert to lock yesterday. And so we noticed that they start ticking up a little. And who knows? I mean, I don't have a crystal ball, and I can't say what interest rates are going to do next week or next year. Hey, stop. Sorry, guys. But anyway, so yeah, that's been interesting to see that and that new fee.
Yeah, I think that's a really good point, especially just going back to the advocacy that and our value too. I think a lot of times people don't always understand what we do as realtors and mortgage officers in the industry, how we go to bat for consumers. I mean, you illustrated a great example of that with legislation, like letting upper people know, hey, you know, us boots on the ground, like this is not a good idea right now.
Right, especially with the economy the way it is. Right. I mean, I don't know. I mean, the other thing is too, you just wonder, I mean, how can interest rates stay this low for an extended period? You just, I mean, lenders and investors are lending money with such a small margin. You just wonder how long it can sustain. I mean, like I said, we're at the lowest they've ever been. I mean, who ever thought we'd, you know, be locking in 30 years at 2.625% or
that's just slightly better than mine, and we got it at 15. And it's just like, I mean we're planning to move soonish, but I mean, depending, Lord's will, lots of things in play here. But like,
right,
you know, still it's great on the buying side, but it's one of those things as a homeowner. It's like, well, shoot, you know, if we were going to stay here, it's amazing just for anybody who's bought in the last 5 years.
Yes. And I think too, you know, especially like the buyers, like you were saying, it is pretty amazing when you do an analysis on the affordability that a borrower has with these low interest rates.
Yep.
Yeah, it's, and that's what I kind of geek out about is, you know, showing borrowers, hey, you thought you could potentially, you know, afford a $200,000 home. Either look how much more home you can buy or look how much less your mortgage payment's going to be with these interest rates. Right.
Yeah. And then just play around with it. And this is where you would have been last year at 3.5% or 5%. I mean, just the difference in interest alone as a part of that monthly payment is huge. So
crazy. And that's
Um,
what too, I don't know if you have this conversation, but you know, those people too, especially I love working with first time home buyers, and I know it's a huge, scary step. I mean, I get it, you know.
mhm,
Um, but you know, when you're trying to weigh out, do I still rent? Do I not? Oh my gosh. I mean, if there's any inkling that you can do it, the equity that you are going to start accruing, oh, I mean,
mhm.
I just can't impress how valid and how what a good move, I mean, no pun intended, but that really is, because oh my gosh, the you know, I don't know what you're seeing as far as home value increases. I've heard nationally we're still averaging about 5% annually.
Yeah,
um
locally in some markets, it's been 11 to 13%, but it's
Gosh,
more specific to the area, like Hamilton County versus Boone County and other
yes.
markets. But yeah, I think overall it's been an 11% year over year average. It's been a
Oh,
minute since I've looked at it. So,
and I was,
but
what was
it's
I,
still, it's super aggressive and it's not sustainable, at
right.
11% year over year.
Right. Like I was doing a refi today for a couple, their taxes haven't even been assessed yet
Yep.
in Westfield. And so they bought the home in 2019. So it's a new construction. I think they paid 321 for it. And what I can do when helping people refinance is we're hoping to get what's called a PIW. It's a property inspection waiver,
Mm.
which means that no appraisal is needed because Fannie Mae or Freddie Mac accept the appraised value that we put in the borrower's file. So I started low and I got a PIW, and I think I started at like 340. Um, and then I kept saying, well, I wonder what it would do next. So I'd go to 350. I mean, I stopped at like 375. So think about that. This person bought this home for 321 last year, and
Mhm.
I'm getting an accepted appraised value by Fannie and Freddie Mac. I mean, and this is rigid. I mean, they're basing it on a huge database of appraisals in their system. And it was at 375, I believe, like I said. So that's
Did that
huge.
did
I
that
mean,
have a basement?
that's a good question. I do not know.
Yeah, I'd be
I don't know.
surprised. I'd be surprised for Westfield if it was 320 with a basement. So probably
That's
not.
probably
So if
right.
it's a two-story at 375, that's still really, really good.
I know. I'm like, dang. Yeah. I mean, that's over 50 grand in equity in less than a year.
Hmm.
So, like I said, I'm such a huge proponent. If there's any inkling in your mind about trying to buy versus rent, gosh, just let somebody help you shake the numbers out. And, you know, if you see it on paper and you can kind of wrap your head around it, I just huge proponent.
Yeah,
And
and I think
yeah,
too, some of the pushback is probably, oh well, I'm gonna buy too much house or be house. I don't want to buy a house and be house poor or have. I
you're
mean,
right.
there's certainly like some fears and concerns that we as agents can help you understand as a consumer and walk through. Um, if you get a house that has a new roof and new mechanicals, then that really helps cut down on the surprises of any big
Hmm.
ticket items that you um, would possibly anticipate in an older home. Not that other things can't go wrong, but those are typically the most cost expensive items.
Right.
So within looking at the numbers and kind of going back to how have things changed since COVID has started,
Hmm.
what are some of the lending restrictions that used to be in place, like credit score minimums that are now the
Yep.
standard, and do you see those easing up anytime soon?
That's a great question as well. So we used to be able to help borrowers with a 580 or greater credit score. Now, this is Highland specific. I unfortunately can only help a borrower with a minimum 620 credit score now. And I know that is definitely lender specific. Um, the other thing is that trying to think, you know, as far as like different products where they were more like jumbo products, for an example, are just not attractive now. The interest rate is horrible. You still have to have 20% down. You have to have typically a 720 or a 740 credit score or better. You know, and really that's all stemming from risk. It's a higher risk loan.
Mhm.
Back prior to this, we did have a bank statement loan for self-employed borrowers that, if they didn't have the tax returns to support income, we could use bank statements, and that has gone to the wayside. I don't know of anyone that does that anymore. From down payment assistance programs, like Indiana Housing here in Indiana, our go-to, we used to use Helping to Own all the time, and
Mhm.
that program does not exist anymore. There's two now, Next Home and Home Ready, I believe it's called. But previously it was like Helping to Own. The down payment assistance was fully forgiven after 2 years of being in the home. Now there's a 3-year requirement on one of them, and on the other, it's like a 9-year requirement where there could be some tax repercussions. So
Yeah.
things like that, there's just a tighter grip, and yeah, that type of stuff, I would say.
Yeah, I always tell people too, with down payment assistance programs, you really have to read the fine print to understand
Yes.
what you're committing to, because a lot of times it's nice up front, and I've had people work with them before and just be aware of what they're signing up for. But like you said, it's a 3-year commitment, or it's a 9 years. I
Nine,
just can't
nine.
even
Yeah.
I mean, I
And
guess
right.
like
And
if you've
it's
got
not like,
kids or a job
yeah.
relocation, like you're gonna have to turn that down unless maybe you tried. I don't even know if there's a solution to work that out privately with
I mean,
them.
there are some very stringent requirement, like meaning you would kind of have to jump through hoops to prove why
Yeah.
you're selling the home prior to the required time frame. But the other thing, like I had a gentleman yesterday asking about this, and another thing, where a lot of them will say you're getting 3.5% down payment assistance. Keep in mind it's an FHA product.
Hmm.
So you definitely need to check with your realtor to know if, in fact, the home you're looking to buy even allows an FHA loan. But with those loans, typically they do require, what's it called? It's a either $1,000 or a $1,200. It's not a reservation fee. It's something like that, though. So in reality, when you think about it, you're really getting approximately 2.5%. I mean, don't get me wrong, it definitely has its place,
Mm.
and can certainly benefit some borrowers, but it's almost, you really need to, fit a square into a square hole, and a kind of like that. Not,
Yeah.
yeah, it's,
Most people, when they look at those programs, in my experience, walk away doing something that unfortunately will have PMI associated, or if they can get PMI, that will fall off after they've accrued so much equity in the home. But a
yep.
lot of times what ends up just on a numbers basis being better, it might not be as convenient in the moment, is, saving and maybe spending a little bit less on the house, and getting something that allows them more flexibility for
Hmm.
life to occur, or it
Totally.
is truly just a better deal on a monthly payment. With down payment assistance programs, do buyers need to anticipate slightly higher interest rates?
That's a good question too. So myself as a lender that we handle Indiana Housing IHCDA programs, you are correct. We do not set those interest rates. Very different than, if you're coming to me for a conventional or an FHA loan that's not down payment assistance related. Yes. So the interest rate, I can tell you now, is higher on those down payment assistance programs versus what I could potentially price you out if you went with a conventional or an FHA loan. Yeah.
Yeah.
That's not always the case, because what happens is these down payment assistance companies, they buy a huge pool of bond loans, and they buy it at a certain rate. And then
Hmm.
once those are depleted, they buy another. So it really depends on what rate they bought them at,
Mm.
to determine what, and they publish those rates to us. So, right, we have no say.
Yeah, that makes a lot of sense. And I'm sorry if we're boring some of you who are tuning in, or, just following us in this discussion. From doing what I do, this discussion is super helpful because it helps understand the nuances of a transaction, and for me to be able to better communicate it to clients, how um, just these slight variations in products can at the time when we're trying to determine maybe who we should work with or in partnering them, or even just in the grocery store, someone sees my name tag and they ask about loan products, because a lot of times it's just assuming that we know everything with real estate. And, so being able to at least have more than a 2-second conversation about it.
Yeah, absolutely. I think, the other thing when you said, post-COVID, I think, obviously still credit score is important. And I hear people all the time say, oh, my credit score isn't, or it's right below 800. What if I got it above 800, would I get a better rate? And really there's cutoff points when you think about interest rate and how that, or a credit score and how that impacts your interest rate. Typically anyone with a 760 or greater, whether it's 760, 782, or 810, most likely they're going to receive the exact same interest rate. It isn't like if you're at 810, 800, like that. The next breakoff point is around 740 and then 720. And unfortunately, back in the day, oh my gosh, I think 720 is still a great score. Unfortunately, where a borrower is really going to get hit hard if you're at a 720 or less on a conventional loan is if they're not putting 20% down and on the PMI rate.
Yep.
For sure.
And for those who aren't familiar with PMI, does PMI fall off on conventional?
It does. So that's the major difference between an FHA loan and a conventional loan. Correct. With a conventional loan, you can request that the private mortgage insurance be removed once you have 20% equity or an 80% LTV in the home, or it will fall off automatically when you're at a 78% LTV. And unfortunately, with an FHA loan, it doesn't matter if you have 50% equity. That PMI never, ever, ever goes away unless you refinance into a conventional loan.
Well, and that makes a lot of sense then, based on what you said earlier, why so many people are refinancing, because if they have accrued enough equity, or an appreciation with value that, and then, or you have some families who are doing landscaping projects or adding the interior value to the home. If somebody comes back out and reappraises it that way, that's another way to prove. So that $20,000 bathroom renovation could actually help lower your mortgage.
No, it's so true. Right. Yeah. And I think too, combined, like you said, with this really nice increase in home values, people are like that example we talked about earlier. My gosh, I mean, that's instant equity. So certainly that can help for sure.
So we have until December 1st to get that in before, if you're thinking about doing it, before you have that half a point.
I mean, if you're thinking it all, like I said, I still think, obviously, some people always say, well, what's the general rule of thumb on refinancing? I've heard so many things. I mean, really, the rule of thumb is if it's going to make a significant difference in your payment, whether that be a 0.5% lower or a full percent lower, and then you weigh that out, the savings over the life of the loan versus what the cost was. So, I think some people really get tied up on the cost of it, the closing cost versus not. There's so many variables that play into this. How long like you were saying, if you're not planning to stay in the home that long, it doesn't make a whole lot of sense to refinance and incur the cost.
Yeah, like if it's $2,000 to refinance and you're only saving $60 and you're going to be there for 2 years or whatever, like that does not make sense.
Totally.
For like another 20 years, maybe, but still it's only $60. So.
Right. What would be key is if you saved, 60 to 100 and then you knocked off the PMI. Right. Yeah, totally. Yeah, exactly.
So we talked about credit minimums, so people can, if you're less than 620, then unfortunately there's not any type of assistance available to make that happen unless they improve their credit score. Is that correct?
Right. Like for Indiana Housing, when you're talking about down payment assistance programs, their credit score minimum now is a 640. And then, right. So if someone, like I just recently had a girl who her middle score, so in mortgage lending, we always use a borrower's middle score, whether it be TransUnion, Experian, or Equifax. And her middle score was 599. But when myself as a lender pulls credit, a lot of times we'll see a number next to your credit score that'll say, it'll say like plus 30 or plus 20 or plus 50.
Mhm.
And then I can go in and run a report where it says exactly what you would need to do as a borrower to
Mhm.
increase your credit score by X amount of points. And like for her, I knew my goal was to get it above 620. And I've seen I'll be honest, every single time I've ever done it, and it's an instant credit score, really. I've had it where a borrower just needed to remove themselves as an authorized user from their spouse's card.
Mm.
I've had it where they need to pay a balance down by $50. I mean, it doesn't need to be monumental in every single case. And in fact, more times than not, I think it's the knee-jerk reaction of the borrower to say, oh my gosh, I'm going to pay off all my debt. I'm going to pay them. I'm like, hold on, hold your horses, because the credit score, a lot of it depends on debt utilization or card utilization.
Yep.
There's algorithms that, make up our credit score. So anytime I have ever given them instructions and then rescored them, every single time, knock on wood, it's
Mhm.
worked. So yeah, so that's
Yeah.
something there is. So don't feel bad. Don't, if your credit score is below 620, there could be something you could do right away.
Mm-hmm. Yeah. And that's exactly what I tell people to do is, what worked for your friend when they were trying to improve their credit might not work for you. And I tell
Correct.
people, we never want to discount ourselves from what opportunities are available until we've been told by that individual that that's not going to work. So
Right.
in this situation, I tell buyers to talk with a lender, have them run your credit for pre-approval and see exactly what your file looks like, because
Yes.
they can tell you exactly what you need to do to put yourself in a better position. And I meet with people all the time that are 1-2 years out away from doing anything because
Mhm.
I counsel them on the things that they need to financially plan for outside of the down payment, because a lot of times people just don't know to think about that.
Right.
Look, if this is what you're thinking of doing and maybe you're just not ready to make that commitment right now, still talk with that lender, because they can tell you where you're at right now. And if you do want to move in 6 months or a year, you can start to implement those changes over time. And I don't know, I'd love to hear your thoughts on this, but I tell them kind of if they are thinking about buying, at least in a 1 to 2 year time frame, to check in at least every 6 months and just kind of report back and say, this is what we did. How does my file look? And not that you want to have a ton of pulls on your credit, but
No, right, right.
realistically, like at least check in with them after you've done that to see if it's updated and if there's anything else that you need to plan for. Because most often, especially referring back to first time home buyers, what happens is people are like, well, I don't know where I want to buy yet, so I'm going to wait till I find the house to get pre-approved.
Mhm.
And then they think because of what they've been able to access online, they think, oh, I've got a
Uh-huh.
720 or I've got a 680, whatever.
Mhm.
And actually you've got a higher debt to income ratio than what's being calculated. Like, what if you're paying child support?
Yep.
And then they get attached to the house, so there's a lot more emotion involved. They tell their
Mhm.
landlord that they're moving out, so then
Mhm.
they put themselves in a bad position. And then you just invite all of the stress, where if you had had those discussions up front, which I know it's an uncomfortable, awkward conversation to invite someone else into your financial
I know.
situation, but um, you save yourself so much stress if you do it early. And then a lot of times, even if that's not you, like say, like for those watching this, you are in a great situation, still check in, because a lot of times that check-in and analysis that the lender provides, they can make recommendations that actually will get you an even better interest rate. Because
Totally. Yeah.
um, correct me if I'm wrong, but it's my understanding that the credit reporting bureaus, they have different dates. So you might pay your bill on
Yes.
one date, and if you just change when you pay your bills and give yourself a few months, you can just positively impact it that way. Is that right?
Absolutely. Yes, it's absolutely. I mean, I swear I get like goosebumps the way you're talking because I get so geeky about this, but the biggest thing is I don't want people to be frustrated. I vividly remember, God, seriously, I have like goosebumps that this girl was referred by an agent. She had been told by another lender, totally down talk to her, put her down. You are never going to get a home. I'm not kidding you. I could show you the text. And I was like, well, let me just see. She was below 600. Because the problem back when we could do or use credit scores below 600, there were overlays. They're called overlays, meaning like, for example, a borrower would have to have 6 months of liquid reserves. Well, who's got 6 months of mortgage payments sitting around all the time? But I said, let's try and rescore you. We rescored her. We got her above a 620. She was in tears. She was like, why did this lender say this to me? So I think you really did. You nailed it on the head. I mean, when a lender pulls your credit or a hard pull, as long as you're not doing it every 45 days, I mean, it should really only impact your credit score by 2 to 5 points max. So you're not going to take this huge 50-point, deficit. But like you said, I think it's so critical to come up with a game plan. I mean, at least if anything, how do you know what to do if you don't even know where you stand?
Yeah.
And that's just me. I'm just one of those people like, okay, tell me where I'm at. Tell me where I need to go. I like to see it on paper. Numbers don't lie. And just really have a good plan of action but like you said, I think too, some people I think really surprise themselves. They go in thinking, oh, we're not going to buy for a year. And then all of a sudden, it's actually a much better picture than they ever anticipated.
Yeah.
Yeah.
And I think there's a lot of apprehension about the buying for first-time home buyers, because once you've bought before, you get the anxiety part over, and then
Right.
it becomes, oh, I've got to sell my house. Where am I going to go? And that's
Right.
entirely different. It's almost like, I haven't had a child yet, but so I'm hearing this through close friends of mine, but it's kind of like the concept of being okay with being pregnant. And then it's the idea of, oh, I'm going to have a child. Like they're
right.
Stuff.
Yeah.
That's like, just kind of the emotions around it. But I think for people who are looking at choosing to go ahead and pursue homeownership for the first time, I think a lot of that anxiety isn't so much necessarily around the commitment and can I take care of this? Is this house going to be a blessing rather than a curse? But it's more about the clarity around their financial situation and are they borrowing too much? And that's just something that you got to take that first step and got to partner with a lender that you trust and have those good relationships in play.
And I so agree. And I always tell people, I don't know, this is the only analogy I can think of, because I get it, like you said, this is personal stuff. I mean, sometimes you're looking at tax returns, sometimes, but really, I think about myself, it's almost like going to the doctor or going to whatever. The doctor sees the patient, they just see the patient, they're trying to analyze what is wrong or what the symptoms are and stuff. I mean, I'm just looking at numbers on paper, really. I mean, at the end of the day, yes, you are, don't get me wrong. I mean, I become connected to all my borrowers, but at the end of the day, it's really, we're just honing in on your numbers and trying to make you or advise you to make the best decision. And there's like a simple example would be, we had a recent first-time home buyers. They were engaged, so they wanted to buy the home together. The spouses, the husbands to be credit score was significantly less than the wife's, and so the interest rate would have been a lot higher had we kept him on the loan. They had great heads on their shoulder. They did not want to be house poor. So I said, let's try and qualify you, the girl on the loan by herself, used her really stellar high credit score. And then we just made sure that he was put on title and deed. And it just, there's different nuances and tweaks we can do to help or advise that
Yeah.
maybe just to the person who's never done it has thought about.
Yeah. I think my thought around that is hopefully they don't break up.
I know, right? Well, no, they're married now. They did get married.
Oh,
It's
okay,
like,
good.
yeah, and literally they closed in like less than a month ago, and they got married like 2 weeks later. Thank goodness. So
Yeah. Yeah.
yeah,
So that's for those who don't follow, our concern around that is um,
yeah,
if someone's not on the mortgage, but they're on title with you, if you go to sell, guess what? They're going to have their share of the proceeds. And so if they're not paying, then
yep,
obviously you want them to be on the mortgage with you. So I'm
right,
happy that that had a happy ending for right
yeah,
now.
yes,
Not quite
yeah,
stable.
totally. So, but
Um,
yeah, it's I enjoy it. I mean, it's so I love learning people's backstories, and I always say honestly, there's no question that is too. It's no stupid question. I mean, ask away. I mean, I would feel horrible if, our goal is to give you as many options and then let you make your own educated decision.
yeah, I
Yeah.
think that I would invite any client or someone who's watching this to reach out to either of us if you have questions. And I know we are in humble little Indiana or Indianapolis. So there's a really good chance though that through either one of us that we are able to connect you with someone local in your area that I've either personally shook hands with because I go to real estate conferences all the time. So there's a good chance I know someone in your local market who I feel like is a good agent and has a good track record and will treat you with the type of professionalism that I would expect from if I was a consumer. And then secondly, Kim, does your company serve like mortgages all across 50 states or
Yeah,
what?
we do. I know, like I said, we actually have branches in 17 states, and I was looking at the map today. We're licensed in not all 50, but quite a few. In fact, personally, Mike and I are licensed, or Mike is licensed in Illinois as well, so we can help people in Illinois. Um, so if not, though, like I said, I've got friends. I used to live in Arizona and all over the country, and if somebody reaches out, we can certainly try and connect you with someone that we trust to take good care of you.
Yeah, and find a Highlands version in your area.
Yeah, exactly. Yeah. So,
Well, we've talked a lot about buyer tips and COVID changes.
mhm.
And wrapping up here, um, what do you see going into 2021 with lending?
That's a great question. Like you said, I think we'll see what happens with the refi market, and we'll also see if some of those restrictions loosen. Um, the thing that's starting to come up more than not in what I'm seeing are people who have chosen to put their loan in forbearance
Mm.
throughout the COVID. What that means is that you contact your lender, and maybe that you've had a hardship where you are not employed anymore, and have asked the lender to basically forgive you or to you're not liable or obligated to make a payment for a certain period of time. Um, don't get me wrong, that doesn't get you off the hook of making those payments. I've seen a lot lately come in that, they balloon the amount on the end of the loan, but the problem is that if you go to refi on something like that, the mortgage does need to be current, and
Mm.
all payments that missed need to be remade prior to doing that. So yes, it's definitely a good option for some people, but there are some, restrictions as well. So I just wonder in terms of lending, will will that continue as far as the forbearance end of it? And then also, I just don't see a whole lot loosening in terms of those unique portfolio programs. They're especially with the economic environment. I think there's too much vulnerability and too much risk, and I think lenders have learned the hard way that they don't want a rampant amount of defaults, foreclosures.
Yeah, I actually, so in listening and observing the market over the last 6 months or however long COVID's been here at this point, um,
Right.
so a few thoughts. One, it's kind of funny around the jumbo market because you have people that want to buy and are
Mm-hmm.
able to buy. Like
Mm-hmm.
the positions, unfortunately, that could not afford to be eliminated in COVID are the people who unfortunately are in lower income. And
Right.
it's awful. And I actually have concerns about the wealth gap. Like I tend to be like more pro-capitalist, but also conscientious within capitalism. Like I like it's good to make a profit. Like it's good to earn an honest living. But
Right.
to the extent that you're taking advantage of people, that's not okay. And we need to have ethics within that. So my concern is that the people who really need to buy
Mm-hmm.
get into something to start building wealth, because you're not going to build wealth unless you're extremely creative when you're renting. It's
Right.
very, very difficult.
Correct.
So the people who lost their jobs, um, if they are homeowners, they might have equity that they can pull out to
Mm-hmm.
keep paying their bills. But for those who do have their jobs and do have that great income, the lending isn't available. And I feel like for some reason that's just funny or ironic in that
Mm-hmm.
way, but it makes sense at the same time, because obviously we as lenders, you want to be wise to not assume too much risk.
Right.
But I feel like on both ends of that spectrum, the people who really, really need that money, I would hope that maybe over time, it's just going to be curious, Kim.
Yeah,
I'm
I
looking
agree.
like which is going to come back in 2021 first? Is it going to be an easing of restrictions in credits minimums, or do you think the
Right.
jumbo market is going to be something that comes back faster?
Gosh, that is a great question. And I honestly, I don't even know if I should, I don't even,
It's okay if you
yeah,
don't.
I know. I don't know because I think, clearly, I guess we'd have, that's good. Now I want to research to see historically what population or what scenario is the highest risk or historically has defaulted at a greater rate.
Mhm.
Is it that jumbo? I don't know. That's a good question. Is it
Yeah,
the
because
jumbo population?
and
Yeah.
that actually explains possibly why we're seeing such an inventory shortage. Because, like, for example, here in Zionsville, Indiana,
Hmm.
um, there are like it's really crazy the amount of like the lack of listings that we have. Like, I can't find anything in 650 right now. Like, I just can't.
What
And
in the world?
like,
Right.
and if it is a good house on a halfway decent lot, it's gone. Like, so you got to be creative with your off market inventory.
Oh my
But,
gosh.
like for the people who, like, if they have a house to sell in that price point and they are going to be buying jumbo, the
Right.
lending is the one that's keeping. uh, I mean, I don't know if this is the wrong
Right.
conclusion to draw, but in a sense, the lack of um, availability for jumbo products right now is actually creating an inventory shortage because people who would be selling can't get it, possibly. And so I'm
Right.
wondering, and I wanted to ask you this, and I'm glad I just remembered it. When it comes to private lending, do you think you've seen any activity on the private side?
In this scenario, you mean? Like, yeah, I mean, that's the thing, potentially someone who banks with a local, with a bank, um, they would be more likely to potentially have, depending on the, I don't want to say status, but the um, relationship that the borrower has with that bank,
Mhm.
they may be more likely to have a portfolio loan that's called, what they would do is keep it in-house. So they would not be required to sell that on the secondary market to Fannie and Freddie and not be upheld to those guidelines. So that's certainly, so you may, that's a good, I just not sure about that. Fortunately, right now, the max allowable conforming loan limit is $510,400. So the the majority of people that we're doing, those $1 million homes for are coming up with the cash to bridge the disparity. They're taking
Yeah.
that 510,400 loan and then have the extra money
Yeah.
to put down.
Yeah.
Yeah,
No, I'm
great.
really curious, Kim, what, and I don't expect you to know this, but just from my own curiosity, and I'm sure it'll pique yours, is just um, if there's a way to track private lending over the next year, especially in not only the luxury price point, but would
Yeah,
private lending get creative and problem solve and market to the underserved market who, like, obviously, if someone has lost their job, like, it's going to be hard for an institution
right,
to lend to them.
correct.
But if they are, like, if they don't have a 620 but they have the 580, it
Right.
needs to be acceptable. Could a private lending company come up with something that, I don't know, I'm just
I
curious.
know. I mean, that's a great question. I know. And that's the thing. I mean, I've seen a borrower that, had a foreclosure less than 7 years ago. And, unless they're going to go to there's nothing that we could do because of those guidelines. I mean, so right, that would be another scenario where, I mean, okay, maybe they have great credit now, but yeah, that's a great question. Actually, one of my neighbors is a private banker. I should talk to him.
Yeah, I'm
We need to
having,
have a part 2 of this so we
yeah,
can like hash this out. I need to come back with some answers. I wrote down some notes though, for sure.
yeah, I'm
Because
actually,
it is. I mean, it truly is. I mean, that, and I think that price point where, back to the first time home buyer, my gosh. I mean, I know if you want a home between a house between 100 and 275, good luck. Oh my God, are you seeing that?
oh yeah, like, I mean, I tell people 175.
Oh,
If it's 140 to 160, you're probably looking at dingy carpet and a really outdated kitchen.
yeah.
Um,
And
with
you better have a very clean offer and
Yeah,
don't ask for any closing costs. Yeah.
yep, yep. Or if it is that price point, and this is also like more specific to the north side, if you go south, like, you can get better deals generally speaking, but even then that's still kind of laughable these days.
Right.
So I set the expectation at 175 for a detached single family, and around 120, 140, depending on the area for condos. So
Right.
if it's a townhouse, probably north of 200, probably 225 price point,
Mhm.
depending again on location. But
Right.
yeah, it's just nuts. I think our average right now across central Indiana, or central Indiana, is like 228. So
That's the average price point right now?
yeah.
Interesting. What are you seeing as far as like that higher price point that we're talking? Is that a much smaller percentage of the inventory available, or is it kind of like a bell curve where
Yeah.
okay.
Yeah. Yeah, your median, I mean, it's been slowly creeping up, like 350, 400 without breaking a sweat. What really blows my mind is 2 stories that are north of 350 without a basement.
That is nuts.
Yeah.
Right.
Like, and I tell people
Well,
too,
I mean, oh yeah.
if you're thinking of building,
Okay.
I tell people to think about what the buyer's expectations are going to be when you go to sell, because assuming the market is going to continue to appreciate,
Hmm.
is the buyer at 375 or 400 going to expect 4 bedrooms? Yes.
Hmm.
Are they going to expect a basement? Yes. Now,
Hmm.
technically speaking, your house is not going to be isolated. Everybody else around you is going to reflect those values, but
Sure.
still, I mean, so, and you have the new construction costs. I mean, it's expensive to pour a basement and add that concrete, but I think if you can do it, I mean, ranches with basements are
Oh,
a recommendation.
I know, right? Oh my gosh, right. And I think too, like I said, we live in an older home, um, with a 2-car garage, and I don't, yeah, that whole thing too. I mean, gosh, there's so many. I just can't imagine 350, like you said. That's a nice home without a basement.
Hmm.
At that
Yeah, and
price.
that's more reflective of newer construction. But yeah, if you're looking at Westfield, um, Westfield, it's easy. So
Mm. Yeah. Are you seeing turn times on new builds? Are you seeing like any delays or
I've
heard of
heard,
delays?
well, I'm being quoted 6 months right now.
Okay,
So
that's pretty standard.
I've got builds in like March, April timeframe right now, but obviously that's got an asterisk next to it.
Right,
So
right.
I think people don't realize how supply chains being disrupted, not only because of COVID, but natural disasters. I mean,
Hmm.
um, my dad's a salesman for a local supplier, and so they are the ones who supply the HVAC, furnace, etc. And so
Oh
I
yeah.
get to hear, the domino effect that happens within that industry. And because of hurricanes, a big PVC pipe, um, uh, I almost said the wrong word, but a big, I'm having a mind blank at the moment.
Yeah.
It's a plant, a location or
Oh,
distribution center
oh, got it. Yeah.
for PVC piping, and they're one of the
Right,
largest in the nation. They got
right.
flooded and they could
Oh,
not produce. And so my dad was saying last weekend that he has clients where they will get a call from the company with an order on the way, and they won't know how much that order total is for until they get the call, because it's so up in the air.
oh
So like
my.
he has people that are buying like way more than they need to, just so that they
Right.
can be able to complete not only the current jobs but any possible upcoming. So it's crazy.
That's crazy. When you talk about that too, I have a friend who just closed on those townhomes in Zionsville, the Lennar
Hmm.
ones over
Hmm.
behind McDonald's,
Yep.
and she just closed yesterday. And I went to see it, and she was saying that, I mean, her appliance is like, sparkling new. And she was like, yeah, Lennar told me that I'm the first townhome here to have all appliances that match. Everyone, they have mismatched because they couldn't get
Yep.
congruent appliances because of, yeah.
I've
So I
actually,
was like, oh, you lucked out.
yeah, I heard, so Builder Magazine did a webinar where they said that they are starting to see some builders, and I think it's more reflective of production builders
Yeah.
than maybe small custom builders, but because production builders don't want to have delays in their closing timelines, they
Okay.
have warehouses sitting full of appliances, and they won't schedule any new builds without being able to verify that they have those appliances in hand.
Oh, no way. Interesting.
Yep.
There, yeah. I mean, it, like you said, it's that domino. I don't know. I mean, yeah, we don't need any more hurricanes. We need no blizzards this winter.
No wildfires. I mean, that was the
No.
other big thing with lumber right now. The price of lumber has doubled. So again, if you are thinking of building, do it now, because the
No. And
price
call
increases.
Jessica because, right, I mean, that's what blows my mind. I think hate to bring this up when we're talking about new builds, is the number of buyers that feel like they're going to get a better deal if they don't have a realtor. And I'm like, no, that's not how it works. They don't, just because you go in and say, I don't have a realtor, it doesn't matter. That you protect your buyers so much. It is so beneficial. I don't know why. I feel like it's such a misnomer.
Yeah. I had a client recently that I met at an open house like 2 or 3 years ago, had
Mm-hmm.
coffee with him, first time home buyer, and followed up. And he works a ton, so we never really got to connect much, or I didn't always get a reply back from him.
Right.
And a couple weeks ago, out driving, showing houses, and he's like, hey, I want to build. I know exactly what I want to build, who with, but I want to have your representation because I know that that's really important. We talked about that, and I was like, great. So,
Right. Oh
but
my gosh. Right.
I say that because when we were looking at elevations,
Okay.
what he picked out, I was like, buddy, I commend you for wanting to save money, but if you're willing to spend a little bit extra here, and like we're not talking a crazy amount of money,
Right.
I was like, I've seen this house be listed before, and it sits because the elevation is terrible.
Right. No, I
So
mean,
not everything that the builder puts in front of you is going to be a good thing for resale. Sorry, builders, but
right.
like it's just So that, unfortunately, like I added a little bit to the bill there, and we were able to get a little
But
bit
can
off.
you
But like,
imagine what the return will be? Right.
yeah, he's going to have a much easier time selling now.
Right. And like I said, you can only get that from someone who's lived it and dealt with it and seen it. And yeah.
Yeah.
So
I told him, I was like, as far as I'm concerned, I'm your realtor for life. I mean, that's my goal with any of the clients that I work with, is I want to earn that opportunity. But so when we look at whatever they buy or build, what are the pain points going to be when that happens? And so it's important, especially when building, that you do it right the first time, because you can't change your elevation. I mean, you can, it's just going to be outrageous.
right. Right. Totally. No, I agree. But yeah, I think, definitely with inventory, I think a lot of builders are trying to keep up with, some call them showcase homes or QMI, quick move-ins. There's a lot to be said. If I remember when Mike and I got in our first home, we lived over by like Allisonville on 116th, and we built, back then it was like what was the builder? They're no longer even in business. And I just remember thinking, oh my gosh, it's our first home. Like, I want skylights and I want the best cabinets. And now looking back, I'm like, why did I think this was my forever home? I mean, it was a $122,000 home.
Wow.
We ended up selling it to friends. We basically broke even. But that's one thing I would always say, definitely don't try and get the home that you want, but especially on it's not going to be the Taj Mahal. I mean, there's things that make sense, like you said, an elevation where you're going to get a good return versus a skylight that's going to look all foggy when you go to sell it. And
yeah. We as realtors like to joke that there's two kinds of skylights: ones that leak and ones that will leak.
Right. I know. So what was I even thinking? I do not even know.
Nope, they're pretty. They add a wonderful amount of natural light. It's also a hole in the roof. So
I hadn't heard that about the leaking part. That's pretty funny.
yeah.
So anyway, but all the more to have someone like yourself help guide through the whole process, and just really to protect the borrower. I mean, there are so many things on a contract. I still am like, oh my gosh, to just help navigate that. You're their advocate. You're there to ask the questions that maybe they don't have the courage to do. I mean, that's what you do.
Yep.
So,
And we chase the sales consultants around when they don't get
want to
back
be
with us. But yeah.
And the lender. Oh yeah. So,
but I think this has been incredibly helpful, Kim. And we can certainly do a follow-up in the next couple of weeks and just kind of see where things are at with COVID and any future tips. I mean, I'm sure there's always something to talk about in lending.
I'm telling you, I can. It's tough to keep up, but it's definitely an interesting environment now. And I know there'll be, especially with this election coming up, news on COVID. We could have, like I said, we need a part B and C to this for sure.
Yeah. Well, let's bring you back in a couple of weeks and make that happen. In the meantime, if somebody wants to connect with you, what's the best way to do that?
Yeah, sure. You're more than welcome to give me a call. My phone number is 317-289-5811. Or you can check out Mike and my website at it's www.2TODewitt.com. So that's www.todewitt.com.
Got it.
DeWitt. I know it sounds like it could be a two, but anyway.
We'll have to put that in the post/comment section for people to check out. But Kim, thank you so much for your time, and everyone for joining us. We appreciate you, and we'll look forward to having you back soon.
All right. Hey, thanks, Jessica.
My pleasure. Have a good night.
See ya. You too. Bye.
Bye.